The first thing you need to understand is that for billionaires, debt is not a burden, it is a tool. For most of us, and I mean the vast majority of working Americans, a mortgage is a necessity. We don't have $400,000 or $600,000 sitting in a bank account. We need the bank to lend it to us so we can own a home. We pay it back over 30 years, and a big chunk of what we pay is interest. The bank profits, we eventually own the house. That's the deal most Americans make. But for someone worth $1 billion, the math is completely different. They could pay cash. The question they're asking is not, can I afford this? The question they're asking is,
let me break down the math in the simplest terms possible, because this is the part that makes the most sense once you see it clearly. Imagine you have $10 million. You want to buy a $5 million house. Option A, pay cash. You now own the house outright. You have $5 million left. Option B, take out a mortgage. You put down a small amount and borrow the rest at, let's say, a 5% interest rate. You now have $9.5 million still working in your investment portfolio. Now, here's the question. What is your investment portfolio doing? If your investments are earning 10% a year, and historically the stock market has averaged returns around that level over long periods, then your $5 million that you kept invested instead of putting into the house is earning $500,000 a year. Your mortgage interest on that same $5 million might cost you $250,000 a year. You just made a $250,000 profit from the decision to borrow instead of pay cash every single year. That is why wealthy people take out mortgages, not because they need the money, because the money they keep invested earns more than the interest they pay to borrow. The technical term is positive leverage, when your return on capital exceeds your cost of borrowing. As Castanis explained it directly, if they believe their investments will yield a greater return than the interest they're paying on a mortgage, it makes more sense to finance the property. It's less about the cost of the loan itself and more about optimizing where their money is placed. Now, there's another piece of the math that makes this even more attractive: inflation. When you borrow money, you borrow today's dollars and repay them with future dollars, and future dollars in an inflationary environment are worth less than today's dollars. So in a period of even moderate inflation, say 3% per year, a debt that costs you 5%
Now let's talk about taxes, because this is where the story gets even more revealing and, frankly, more controversial. In the United States, mortgage interest is tax deductible on loans up to $750,000 for taxpayers who itemize their deductions. For ordinary homeowners, this is a modest benefit. But for ultra-wealthy borrowers, the tax implications of their real estate strategy go far beyond the basic mortgage interest deduction. Here's the bigger issue. Wealthy individuals, particularly founders and executives whose wealth is tied up in company stock, face a specific tax problem. If they sell their stock to raise cash for something like buying a house, they trigger capital gains taxes. Depending on how long they've held the stock and how much it's appreciated, that tax bill could be enormous. We're talking about tens of millions of dollars potentially on a single transaction. So what do instead? They don't sell. They borrow. This is the practice known as securities-based lending. Instead of selling stocks or other assets to raise cash, wealthy individuals use those assets as collateral for loans. They pledge their shares to a bank, the bank gives them a loan, and they use that loan to buy a house, or a yacht, or fund a lifestyle, or invest in something else. The assets never get sold. No capital gains taxes are triggered. The loan proceeds themselves are not treated as taxable income under U.S. law. And here's where it gets generational. When the billionaire eventually passes away, their assets go to their heirs. And thanks to a provision in U.S. tax law called the stepped-up basis, those heirs receive the assets valued at the market price at the time of inheritance, not at the original purchase price. That means all the accumulated capital gains that built up over decades can simply be erased at death. The heirs can pay off the outstanding loans by selling some of the inherited assets, and they pay taxes only on any gain from the point of inheritance forward, not on the lifetime of appreciation that came before. J.P. Morgan has described the appeal of this directly to its wealthy clients. Rather than selling public market investments to raise money, borrowing against assets allows you to stay the course on your investments, defer taxes, and free up money for other opportunities. It's a way to tap into the value of what you own while keeping your financial plans intact. This is the system as it was designed and as it currently functions.
Now, I want to introduce you to 3 words that have become one of the most debated phrases in American personal finance and tax policy. Those 3 words are buy, borrow, die. The buy, borrow, die strategy was first described academically by USC law professor Edward McCaffrey back in the 1990s. It has since become the defining framework for understanding how the ultra-wealthy accumulate and preserve fortunes across generations, often paying remarkably little in taxes along the way. Here's how it works, step by step. Step 1, buy. Acquire assets, stocks, real estate, business equity that are likely to appreciate in value over time. You don't need to sell them, you just hold them and watch them grow. Step 2, borrow.
When you need cash for spending, for purchasing a new property, for funding a lifestyle, don't sell the assets. Instead, borrow against them. Use the assets as collateral for loans. The loan proceeds are not taxable income. Your assets keep appreciating. You keep compounding. And because borrowed money is not income under U.S. tax law, you can fund an extremely wealthy lifestyle without ever generating a taxable event. Step 3, die. When you pass away, your appreciated assets transfer to your heirs. Thanks to the stepped-up basis rule, the accumulated capital gains essentially disappear at the moment of inheritance. Your heirs can sell the inherited assets at little or no capital gains tax, pay off whatever loans are outstanding, and continue the cycle. The most famous practitioners of this strategy are people like Larry Ellison, the co-founder of Oracle, who's pledged more than $3 billion of his Oracle stock as collateral for personal loans without ever triggering a taxable event from selling shares. Elon Musk has pledged significant portions of his Tesla shares as collateral for loans over the years as well, though he is also noted paying billions in taxes when he exercised stock options. Jeff Bezos, for his part, has publicly pushed back on characterizations of this strategy as tax evasion, saying there is no truth to the suggestion that he relies on it as a primary tax avoidance tool. The picture is complicated. Some of the world's wealthiest individuals do pay enormous tax bills when they sell or exercise options. But the structural advantage of being able to borrow against appreciating assets instead of selling them is real, documented, and widely practiced. Senate Finance Committee Chairman Ron Wyden highlighted the stark contrast in public hearings. The average billionaire ends up with an effective tax rate of around 8%, while a nurse or firefighter making $45,000 a year pays a 22% marginal rate on their wages. Working people pay taxes out of every paycheck. The ultra-wealthy, in many cases, can choose when or whether to create a taxable event at all. That is the power of buy, borrow, die.
Now let's step back from the billionaire world and look at the other side of this story. Because while Musk and Zuckerberg are using mortgages as wealth optimization tools, most Americans are struggling to get a mortgage at all. The housing affordability crisis in the United States has reached a generational extreme. As of early 2026, the average 30-year fixed mortgage rate sat at around 6.48%, according to Freddie Mac, down from the peaks of the recent cycle, but still more than double the historic lows that made Zuckerberg's 1.05% mortgage possible back in 2012. More than 75% of homes across the United States are now considered unaffordable for the typical household, according to a Bankrate analysis. The personal finance firm defines affordability as housing costs that don't exceed 30% of a household's income. By that measure, only a sliver of the housing market is accessible to average Americans. Households earning $75,000 a year, which covers teachers, nurses, tradespeople, and many other middle-class professions, can only afford about 21% of homes currently listed for sale. That is down from 49% of listings just 6 years ago in 2019. The contraction has been staggering. Even households earning $100,000, which puts you solidly in the upper middle class, have seen the share of affordable listings collapse from 65% in 2019 to just 37% in 2025. The Atlanta Federal Reserve's Housing Ownership Affordability Monitor found that as of mid-2025, owning a median-priced home consumed nearly 48% of the median household's income, almost double the 30% threshold traditionally considered sustainable. That is not a housing market. That is a housing crisis. The average age of a first-time homebuyer in the United States has now hit 40 years old, a record high. A milestone that previous generations typically hit in their late 20s or early 30s is now being pushed into middle age for millions of Americans who are doing everything right, working hard, saving diligently, and still finding homeownership out of reach. And in the country's most expensive Now, here is the part that I think matters most for most people watching this video. What, if anything, can you take from the way the ultra-wealthy think about mortgages and debt and apply it to your own financial life? Because I want to be clear about something. You are not Elon Musk. I am not Elon Musk. The specific strategies that work for someone with hundreds of billions in assets and access to Morgan Stanley's private wealth division are not going to translate one-for-one to the average American household. The securities-based lending, the pledge your stock portfolio move, the generational estate planning with stepped-up basis, those require the kind of wealth and access that most people will never have. But the underlying principle, the core financial logic, that is worth understanding and applying at whatever scale you operate. The principle is this: not all debt is created equal. Debt used to acquire an asset that appreciates in value, a home in a growing market, an investment portfolio, a business, is fundamentally different from debt used to buy things that depreciate or disappear. A mortgage on a well-chosen property is categorically different from credit card debt. Understanding that distinction is the beginning of thinking the way wealthy people think about money. The second principle is opportunity cost. Every dollar you have is making a choice.
If you put it in your mattress, it earns nothing, and inflation slowly destroys it. If you put it into a fully paid-off house, it earns the appreciation of that house and nothing else. If you keep it invested in a diversified portfolio while carrying a moderate mortgage, it earns the return of the portfolio minus the cost of the mortgage. The question you're always asking is, where does this dollar produce the most value? Evan Harlow, a real estate agent at Maui Elite Property, put it well when he told Fortune, the takeaway for the average buyer isn't to mimic their precise approach, but to understand the principle. Sometimes the smartest financial move isn't paying everything off, but keeping your money flexible and working for you. Now, it's important to add, that principle has limits for regular households. If your mortgage rate is 6.5% and you're not sure you can reliably earn more than
Let's zoom out one more time, because this story is ultimately about more than mortgages. It's about two entirely different relationships with money and two entirely different sets of rules. When the Wall Street Journal reported on U.S. wealth concentration, it noted that only the richest 1% of households have grown their share of overall U.S. wealth since 1990. Federal Reserve data backs this up. The mechanisms we've been talking about today, leveraged real estate, securities-based lending, buy, borrow, die, stepped-up basis, are significant contributors to that concentration. Not because they are illegal, none of them are, but because they are structural advantages that compound over time and are only fully accessible at a certain level of wealth. Politicians on both sides have grappled with this. Senator Ron Wyden and others have proposed a so-called billionaire's income tax that would tax unrealized capital gains, essentially making the mark-to-market on appreciated assets taxable each year rather than only upon sale.